Hello again from me, Rossouw. I'm a portfolio manager with Adviceworx Private Client Securities, and I'd like to spend the next 20 minutes or so talking to you about recent developments which affect the global economy and investment markets. The streets of Shanghai, China's largest city and the world's sixth biggest, are normally bustling, but last month they were eerily silent. Because of China's draconian zero-COVID policy, the city was subjected to a near-total lockdown when a surge in COVID cases began in early April. The city's 24 million people have now endured virtual house arrest, food shortages, and overwhelmed hospitals for 4 weeks. Since then, a similar lot has befallen the 21 million citizens of the capital, Beijing. China's controversial stance on COVID has exacerbated global supply chain issues and its own economic slowdown. By the end of April, more than 512 million people had tested positive for COVID-19 worldwide, and 6.25 million people have now succumbed to the disease. The United States remains hardest hit, with nearly 83 million infections and over 1 million deaths. India, Brazil, France and Germany now make up the rest of the top 5 in terms of most recorded cases, and South Africa has thankfully slipped down from 27th to 30th position. The number of new cases recorded per week kept on falling during April, as did the weekly death toll. To date, more than 5.15 billion people, or nearly 2/3 of the world's population, have received at least one dose of vaccine, and an estimated 4.65 billion people can now be regarded as fully vaccinated. More than 11.6 million doses of vaccine have now been administered, and the vaccination rate has fallen to around 12 million per day, which is unsurprisingly given that so many people are already vaccinated. Thankfully, the percentage of people in low-income countries vaccinated has risen to more than 15%. The global economy faces a perfect storm. Rising inflation and interest rates, the war in Ukraine, and China's obtuse COVID policies are mutually reinforcing shocks to the system. Together they have the potential to cause stagflation, that noxious combination of slow growth and ever-rising prices. The International Monetary Fund recently lowered its GDP growth forecast for 2022 from 4.4% to 3.6%, and at the same time raised its inflation forecast from 3.9% to 5.7% for developed markets and from 5.9% to 8.7% for emerging markets. The good news is that the expected growth is still in line with long-term trends, just not as strong as expected in January. Consumer and producer price inflation in developed markets are both at or near multi-year highs, with little sign of abating. As a result, bond yields are rising in most countries as the market prices in substantial interest rate hikes. Because interest rate policy is a blunt instrument, there is a real risk that central banks can overdo rate hikes and choke off economic growth, which is already under pressure. China's central bank is the notable exception and is in fact stimulating the economy in an attempt to boost sagging consumer demand. The US Federal Reserve is the most hawkish major central bank because the US economy is booming. The European Central Bank is less so because the war in Ukraine could lead to a Eurozone recession, and the People's Bank of China is mainly focused on keeping Chinese consumers happy. Global food prices are at record levels and still rising. The reduction in grain and sunflower oil supply from Russia and Ukraine has seen the global food price index spike in recent months. Cooking oil now costs 3 times more than 2 years ago, while wheat and maize prices have risen by around 70% over the same period. The ongoing war poses a number of threats. Sanctions will keep Russian output from most markets, fighting will prevent Ukrainian farmers from sowing and harvesting, and the destruction of ports like Mariupol and Odessa will make exports physically impossible. The recently adjusted IMF global growth forecast shows how the war in Ukraine will affect different countries in vastly different ways. While the US economy will lose momentum, this will largely be due to tightening monetary policy and not the war. The Eurozone, however, is likely to slow down because of higher energy prices and the possibility that Russia halts gas and oil supplies to it. Japan could actually see stronger than expected growth. Among major emerging markets, Russia will understandably be the hardest hit. China will see a sharp decline in growth, but mainly because of internal dynamics and not the war. India will hardly skip a beat, and Saudi Arabia, the world's biggest oil producer, could well end up the biggest beneficiary of Western sanctions against Russia. The Chinese economy is facing headwinds on a number of fronts. The graph on the top left shows how its zero-COVID policy has diminished its trade, and the one on the top right shows how lockdowns have reduced retail sales. On the bottom left, we see how industrial output has fallen off, and the graph on the bottom right-hand side shows how property development has slowed in the wake of the Evergrande fiasco. April was a poor month on global equity markets, with the S&P 500 suffering its third worst first third of a year in history. The hardest hit markets were Shanghai and Shenzhen, and foreign portfolio investors are voting with their feet and wallets. It was reassuring, however, to see that US company results for the first quarter were generally still strong. How markets fare during the rest of the year will mainly depend on whether companies can continue to grow their earnings in a rising interest rate environment. The US dollar is strengthening while commodity prices are falling. The month's biggest corporate news was Elon Musk's hostile takeover of Twitter. As mentioned before, equity markets spent the month in downward mode. Despite the war on its doorstep, the Euro Stoxx 600 suffered less than the United States and Japanese markets. An increase in risk aversion is almost always bad news for emerging market equities, and April was no exception. The MSCI Emerging Market Index lost more than 5% for the month, but this was largely due to a sharp decline on mainland China's markets. The MSCI China Index is now down nearly 18% for the year to date. After a record-breaking 2021, the S&P 500 has had a torrid 4 months thus far this year. The index is down nearly 9% for the year to date, with the big losers being technology stocks. Apple is down just under 10%, Microsoft a full 10%, Alphabet, Google's parent company, 18%, Amazon nearly 24%, and Netflix more than 49%. All told, the big tech companies known collectively as FANGs lost $1.4 trillion in value during April. The worsening outlook for the global economy has led to a drop in demand for most industrial commodities, with the notable exceptions being natural gas and coal. Even the prices of the so-called battery metals, lithium, nickel and cobalt, have come under pressure. For the month of April, the best performing commodity was natural gas, followed by coal, and the worst performer was aluminium, followed by uranium. Over 12 months, lithium remains far ahead of the pack, and iron ore brings up the rear. At the beginning of the year, prospects for the global economy and investment markets seemed promising. Now nearly all indications are that 2022 will be a tough year, with continued microchip shortages and supply chain bottlenecks still weighing on markets. All told, the operating environment for companies will be tougher than last year, and while equity returns will in all likelihood improve from their current levels, they should fall well short of the levels we saw last year. The bond market will probably remain under pressure while interest rates rise. The big local news for the month was the flooding in KZN over Easter. Hot on the heels of last year's plunder and vandalism, these floods caused billions of rands worth of damage in and around Durban. Nearly 450 people died and dozens are still missing, and the damage is currently assessed at well over 10 billion rand. Road and rail transport was severely disrupted, and Transnet had to suspend port operations in Durban and limit activity in Richards Bay. The enclosed picture shows the extent of the flooding at Toyota's plant south of Durban, which damaged hundreds of vehicles. By the end of April, nearly 3.8 million South Africans had tested positive for COVID-19 and 100,363 people had succumbed to the disease. The Western Cape has suffered the highest death toll so far, but most active cases are currently in Gauteng and KZN. Health experts warn that the fifth wave of infections is mounting, but early indications are that while the new Omicron BA2 variant is highly infectious, it is less lethal than previous variants, and that existing vaccines will provide ample protection against severe illness and death. To date, nearly 35 million doses of vaccine have been administered, and nearly 20 million people have received at least one dose of vaccine. Of these, 18 million can be regarded as fully vaccinated. South Africa's gross domestic product is expected to grow by a meager 1.9% this year and by only 1.4% in 2023. Inflation is threatening to breach the upper limit of the Reserve Bank's target range, and it is no longer only due to fuel and food prices. Unsurprisingly, the Monetary Policy Committee raised the repo rate by 25 basis points in April, with more hikes to come. The slowdown in China is bad news for South Africa's miners and farmers, and Eskom has had to resort to desperate measures to keep the lights burning most of the time. According to the Africa Wealth Report, South Africans are becoming poorer in global terms due to the emigration of high net worth individuals and the depreciation of the rand. After 5 years of relatively low inflation and correspondingly low interest rates, South Africa is flirting with the 6% level once more. This is a worrying development, since stubbornly high inflation will force the Reserve Bank to raise interest rates, which in turn dampens growth. Sadly, a reprieve is unlikely, as the rand is likely to weaken against the US dollar now that US interest rates are rising. Since South Africa imports most of its fuel, manufactured goods and intermediary goods, a weaker rand means importing inflation. In most countries on Earth, railways form the backbone of the transport system. Commuting by train is particularly popular among low-income workers, as it is the most affordable means of getting to and from work. Sadly, this is not the case in South Africa, with poor train maintenance, cable theft and vandalism causing commuters to turn to buses and taxis as their preferred mode of transport. This graph shows how passenger numbers on our railways have plummeted. Since 2010, the number of people travelling by train has fallen by a staggering 95%. The JSE, like most of its global peers, suffered a significant decline in April. The all-share index gave up 4%, with financials, resources and industrials all losing ground. The industrial sector was spared a worse fate by a late rally on the part of Prosus and Naspers. The bond market also took pain, and the rand depreciated sharply against a rampant US dollar. Toyota's output was set back by the floods in Durban, and Sibanye-Stillwater CEO earned nearly R1 million per day last year. There were very few winners on the JSE last month, with only fuel and chemicals producer Sasol bucking the trend. For the year to date, only the resources and financial sectors can boast gains, but last month financials retreated sharply. The industrial sector was weighed down by Naspers and Prosus in recent months. Despite all the red ink, the All-Share Index remains one of the best performing major indices in the world for the year to date. The 12 months to the end of March produced some interesting asset class returns. The property sector continued its rebound, admittedly off a low base. Domestic equities and bonds managed to outperform foreign equity, partly thanks to a resilient rand. Cash returned less than inflation. Over 5, 10 and 15 years foreign equity reigned supreme, followed by local equity and local bonds. Looking ahead, we see good value in South African equity relative to both its offshore peers and its own historical valuations. How the market will perform is largely dependent on global developments, however. We are not as negative about the medium-term future as some commentators, however, and certainly see little likelihood of a sustained bear market. The recent run-up in commodities, excluding energy, is unlikely to resume, but we are positive about the prospects for non-commodity rand hedges. We expect a well-diversified equity portfolio to deliver a positive return in 2022 and continue to favor bonds and avoid cash. Allow me to conclude a seemingly gloomy presentation with a bit of long-term perspective. A poor start to a given year does not necessarily mean that the rest of the year will also be bleak. In the nightmare years of 1932 and 1939, the S&P 500 fell sharply during the first 4 months and then recovered a lot of lost ground over the rest of the year. In fact, in 4 of the 15 years with the worst starts, the market ended up in positive territory, and the same might well happen this year. By selling out of equities at the bottom, we simply convert a theoretical loss into a real one. If you have a sound long-term financial plan and appropriate asset allocation, the best course of action is to be patient and ride out the volatility. Thank you very much for your time and interest. We certainly live in interesting times, and I hope that the contents of this presentation will help you make sense of it all. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I wish you good luck and good health until next time.